Well, hello and welcome to Market Domination. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Case is that we don't actually expect tariffs until later this year. If we do get anything close to what Trump has proposed, that would be a stagflationary impact on the economy, no question. However, if it's something more like that Washington Post article, which still appears to be credible despite Trump dismissing it to some extent, that would be not such a bad thing. We're estimating that would raise about $20-something billion per year, which is very different from $100 to $200 billion if it was something more sweeping.
The big bugaboo right now so far early in 2025, the 10-year at 470. It looks like it's going to go to 5% pretty easy. So again, we got to stay in the lane with more growth or some interesting story stocks, because that's more competition, right? That's a lot more competition in stocks when the Treasury, or if the Treasury yields 5%.
Now let's look at the big picture, the 200-day moving average. Only 51% of the S&P 500 is above the 200-day moving average. The last time we were that low was when? October 2023. When was the last time we had a 10% correction? October 2023. The similarities are there.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We are seeing not much change in the major averages, but we've been bouncing around quite a bit in a range today. Right now, the Dow's up about 30 points, not even good for a gain of 0.1%. The S&P 500, also very little change. The Nasdaq down about 0.1%.
We did get Fed minutes today, which was interesting. It sounds like many of our central bankers, Julie, sort of thought, you know what? Maybe we got to be a little more cautious, a little more stingy with those cuts looking ahead, given what we're seeing with the economy, inflation, the strength in spending. They did talk about how the labor market kind of looks solid. Of course, we got a big jobs report coming on deck on Friday, too.
Yeah, and this is a bit of an unusual week because once again, we have a shortened week. The market's closed tomorrow for the funeral and the national observance for Jimmy Carter, for President Jimmy Carter. And so another kind of in-between week, that jobs report coming when the market reopens on Friday, of course. But as we look at the Fed minutes and that willingness to now be on a pause, we are still seeing the 10-year yields creep up, not moving much today, but of course we've seen that bigger move and that push higher towards 5%. We also have seen that move in the dollar that has been higher. That's had to do something with tariff talk as well. But something that President-elect Trump has said in the past, he doesn't like a stronger dollar. So how that factors into all of the equations, who the heck knows?
It's interesting because, you know, the start of the year, Julie, it has been volatile, and different reasons you'll hear from that. You know, I thought it was interesting, Piper's Craig Johnson, well-known technician. Today he was telling his clients he would chalk that up to two things. One, that you pointed out, if you look at just the benchmark 10-year, we're back to 4.7. And two, listen, he's a technician, so he's looking at what he would consider short-term oversold conditions.
Oh, interesting.
And he's saying, listen, to him, you added up, that has, in his opinion, what's been testing, in his words, investors' nerves and a bit of patience here.
Yes, most definitely. Also testing their patience, maybe the Federal Reserve. So let's talk about that.
Let's.
The minutes from the Federal Reserve's December meeting are out, and Yahoo Finance's Jennifer Schonberger has more for us right now. Hi, Jen.
Hey, Julie, that's right. Looking at those minutes, which come out with a 3-week delay, Fed officials thought it could take longer than anticipated to bring inflation back down to their 2% goal, given the recent higher readings on inflation and the likely effects of potential changes in policy when it comes to trade and immigration. Almost all members of the Fed felt that upside risks to the inflation outlook had increased. Several observed that falling inflation may have stalled temporarily or noted the risk that it could. Many members thought the Fed could hold rates at a restrictive level or cut rates more slowly if inflation remained elevated. Now, all officials felt that the uncertainty about the scope, timing, and economic effects of potential changes in policies put forth by President-elect Trump affecting foreign trade and immigration was elevated. In fact, a number of officials incorporated placeholder assumptions into their projections at this last meeting. And not as much dissent within the Fed as thought, given Cleveland Fed President Beth Hammack's dissent. In fact, a majority of members, according to the minutes, wanted lower rates to help maintain the strength of the economy and the job market while still allowing inflation to drop, though there were some participants who would have been in favor of holding rates steady. The minutes reiterated that what the Fed said in December, that Fed officials felt that they were at or near the point of slowing the pace of rate cuts. So, guys, clearly the Fed not in a hurry here to lower rates, and inflation very much back in focus.
And
Back to
Jennifer, we did hear President-elect Trump speak on interest rates yesterday. Let's take a listen to that.
Inflation is continuing to rage, and interest rates are far too high.
Jennifer, I'm curious, what's the latest in their relationship? Will they clash this year, do you think?
Yeah, that's always the ongoing question, right, Josh? It appears that tensions have cooled recently, but given these comments that we just heard from the president-elect yesterday, certainly sets the stage for a potential clash. If the president-elect feels that inflation is still an issue, clearly something Fed officials agree with, then that sets the stage for potentially holding rates steady, or if inflation starts to increase, raising rates. Now, that is at odds with what President-elect Trump would want, which is lower interest rates. To be clear, Fed officials have said in the minutes today, Chris Waller, Fed Governor Waller earlier today, as well as officials earlier this week, said that they do think that the path forward for monetary policy is still down, though that they're going to take a more gradual approach to cutting rates. Though I would just point out, I think one of the bigger issues right now is the jet up in the yield on the 10-year Treasury. While the Fed sets rates that could influence the 10-year, there are other factors there that influence market forces around that rate, that influence borrowing costs for Americans, particularly mortgage rates.
All right. Thank you, Jennifer. Appreciate it. Stocks mixed today as markets search for direction to begin the new year, but history tells us we're in for another double-digit return for the S&P 500. For more, let's bring in Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, always great to see you. So listen, Ryan, it was a great 2024. You were here with us for a lot of it, my friend. 2025, Ryan, what should we expect after you did have these back-to-back 20% gains?
Well, first off, thanks for having me. I'm in Cincinnati, totally snowed in, so hopefully most of the country is starting to get out of that. And Josh, glad to be back, and Julie, hi, and glad to be back. So let's get into it. We've been pretty optimistic. As you said, I've come on a lot, but we still think this year's going to be pretty good. Now, let's just start high level here. After a 20% gain in the S&P 500, that following year is actually up more than 10% on average, higher 82% of the time. That's better than your at any time return of about 9% and up like 72% of the time. But we're up back to back. We're up 20% 2 years in a row. So listen, that's a lot. We get it. But it's only happened 4 times since 1950. So small sample size, sure. I'd still rather know than not know. Josh, when you have a back-to-back, that next year, only 1 time in the 50s, 3 times in the 90s. That next year's been higher every time, 4 out of 4, up 20% on average. We don't think 20%. We think between 12 and 15 makes a lot of sense, but we think this is still a bull market. We can get into all the weeds of it, but just because we're up a lot, that doesn't mean this bull market has to end. In fact, we don't think it's going to.
Obviously, and it's good to see you. We're not quite snowed in, but it is freezing here in New York City. The sentiment has definitely shifted over the past several weeks, right? Part of that has to do with what we have seen happen in the 10-year yield. So how much of that is going to be an obstacle to your thesis for this year, or is it not?
Well, that's a great question. It's what I'm thinking of every day. Because again, a year ago, when we were bullish, people gave us some weird looks. 2 years ago, we said no recession, bull market. People hated that call. Now I look around, it feels like a lot of people are agreeing with us that things are overall pretty good. But I tell you what, real short term, what are we seeing, right? And you just had some great discussion before I came on. I think Jay Woods pointed out, 50% of stocks above their 200-day. Last time we saw something like that was a 10% correction. Obviously, a lot of stocks have seen some weakness really since, I guess we'll say December. But you look at some of those sentiment polls, right? The NAAIM exposure, RIAs, huge 4-week drop. The AAII, individual investor, like the least bulls we've seen since I believe it was April of last year, a fairly significant low. Put to call ratios, options markets getting kind of freaked out. So Julie, to answer your question, the near-term things we're seeing are flashing kind of what we've seen near lows before. And I'm not saying we're right at a low here, but there's a good amount of fear, and rightfully so. We had a great run, and now all of a sudden, stocks can go down. We were down in December, pretty rare, yes. I did not think we'd be lower in December, but we were. So we have to respect that. But overall, we're in the ballpark, I think, where you tend to get some type of a manageable intermediate term low.
Ryan, to Julie's question on the 10-year, I'm just curious, are there levels you're watching that you think, okay, that becomes a problem for the equity market? There was a piece in Bloomberg, Ryan, that was interested about how there's this growing course of fund managers who say, listen, that Treasury market repricing might not be over. It might have further to go. How options are indicating a spike in the 10-year to 5. Would that be a problem for the stock market?
Yeah, I think so, Josh. I mean, listen, I think 475 is kind of that big level where we were, I guess I could say earlier this year, but it would be last year at this point. We're not that far away from that. Of course, 5 is that major psychological level. I mean, let's be clear, though, why have yields been going higher? I think because the economy is pretty strong. I mean, overall, most of the economic data has been pretty solid. And we're going to get more labor market data soon here. But you think about where, everyone's thinking alike, somebody isn't thinking. That's a famous saying. I use it a lot, General Patton. And everybody feels like is bullish the U.S. dollar and looking for higher rates. And we get why, right? We get why. But just know a lot of this stuff is priced in. Our base case here, over at Carson is we probably see 2, 3, maybe even 4 cuts, not necessarily right away. We still think inflation is going to improve. We had every guest come on with you guys, and I have too, talking about shelter. Look at real-time rent data. Inflation's going to continue to improve. So to us, the economy's pretty solid. Inflation comes back. There's probably going to be more cuts this year than people are pricing in right now. And that maybe not going to happen right away. Might not take till the second quarter, I'll be honest. But some point during this year, we're going to have a lower move in the dollar, lower move in yields. And that's probably going to be pretty bullish event if and when that takes place.
Ryan, I want to ask you a little bit about fiscal policy here. We got a reminder of what a Trump presidency is like again yesterday with President-elect Trump's news conference. He hit on a lot of different topics. I wanted to look back at volatility under his administration. What this chart actually looks at is volatility from election day to election day. And on average, the VIX or the VIX-EQ, which tracks single stock volatility, was actually lower during the Trump administration than during the Biden administration. All else being equal, we know a lot of other things were going on. And so how should investors be thinking about the tweets or Truth Social posts, the press conferences, the pronouncements? How should they be thinking about trading around them?
Well, Julie, that's an excellent question. And I don't think you should be looking to trade around them. At least most investors should not. I mean, we've said this before. It's not about red. It's not about blue. It's about green. Okay. I mean, if the economy is strong, these things have a funny way of working themselves out. Now, remember when Trump won, obviously the first 15 months or so, the first time stocks did amazing until February 5th, 2018. That was the day Jerome Powell was sworn in. Also the day the trade war started. And that's when that huge blast of volatility started. 2018 wasn't very good for investors. A trade war and things were going on. But overall inflation wasn't all that much higher. I mean, listen, everyone has an opinion on this. I think Trump's just talking a big game with these tariffs, and a lot of other people are in that camp. If it spirals out of control, sure. Our bullish thesis, that's one of our number one threats this year, like a lot of other people, is tariffs and spiraling out of control. But the underlying opinions of what got us here, a strong consumer, an overall dovish Fed. We still think we have a fairly dovish Fed with more cuts coming. Strong productivity for 6 quarters in a row. We haven't seen anything like that in our country since the mid to late 90s. All the record profits, record profit margins. I mean, there's worries and concerns, but the pinnings that got us here are still in play. So again, don't get too worked up over politics. One more quick one here. When you have a split Congress, the S&P's been up 13 years in a row. I get it. We don't have a split Congress now, but that house is very, very slim. So, we still are going to have some gridlock. There is that old saying, gridlock is good. Believe me, Congress has some work to do. Those Trump tax cuts, kind of hard to say, are up. They end on January 1st, 2026. I think we're probably going to extend those or at least find some way to work around that. Congress has some work to do, but still the fact that we have a pretty tight house, history would say that's more bullish for the market because you don't have those extreme sways one way or the other with too much spending. And, we like to spend money in our country. It is what it is, but hopefully we can restrain that a little bit.
We shall see. Good luck digging out. Ryan, thank you so much for joining us.
Thank you. I've eaten a lot of Pop-Tarts. Is all we have around here. So, I'm trying. Yeah.
You got to get some different supplies. Good luck.
I know.
Thanks, Ryan. We're just getting started here on Market Domination. Coming up, a crude awakening could be in for oil earnings. We'll speak to a portfolio manager on the other side about how to be best positioned in the sector. Stick around, much more Market Domination still to come. Oil prices are sliding today, and Exxon and Shell are warning of their profits taking a hit. ExxonMobil pointing to fourth quarter earnings suffering from significant headwinds like lower crude prices and narrowing refining margins. Meanwhile, Shell is warning weakness in its natural gas division as it saw lower sales volumes and trading earnings. For a closer look at the oil market, let's get to Tortoise Senior Portfolio Manager, Managing Director, and Managing Director Rob Thummel. Rob, it's good to see you. So I am curious about these two companies in particular, right? Looking at Exxon and Shell. And, you know, obviously the lower oil prices have been mostly a boon for consumers, but not necessarily for these companies. So what does this tell us about, you know, not just last quarter, but how 2025 is going to get started for these companies?
Well, hi, Julian. Thanks for having me. So if you look at Exxon and Chevron, they are energy producers. So their earnings do ebb and flow a bit with commodity prices. And so as you highlighted, you know, we've had lower commodity prices, great for the consumer, obviously stimulates demand, keeps inflation low, but does bring down earnings a bit. But if you just look at the valuations of Exxon and Chevron and the whole energy sector in general, you know, a lot of other sectors you're talking about are at all-time or even above all-time averages. The energy sector is not. It's well below its all-time all-time highs, while a lot of other sectors are above or beyond their all-time highs. And so that's those lower prices are priced into the market. So then it's like, then the thought is, well, what's future demand and what are future prices? And then is that a good opportunity to be buying Exxon and Chevron? And we think that you'll see steady improvement in oil prices, probably a little better improvement in natural gas prices, which will all be beneficial for Exxon and Chevron going forward and help lift their valuations.
Rob, kind of a broader question. Trump moving back into the White House. Drill, baby, drill. It's a Republican mantra, Rob, but I don't think we've had a single energy investor, analyst, or strategist come on this show, Rob, and tell us that, yes, they in fact do expect to see some kind of meaningful pickup in U.S. production, but I'm curious to get your take, Rob.
Yeah, Josh, so I think a way to think about drill, baby, drill, I think the way investors should think about it is, I think you should think about it this way. So drill, baby, drill basically means, in my opinion, that we've got a lot of oil and natural gas in the U.S. And that's thanks to this U.S. shale revolution, U.S. shale technology. So we have a significant amount of reserves across the U.S. And so what drill, baby, drill means to me is that when we need it, we'll be able to drill more and produce more. But the goal will be to keep inflation moderated and keep oil and natural gas prices at moderate levels so that they just don't get out of control. And so if prices would elevate substantially, the U.S. has the ability to increase their drilling activity, and then ultimately that results in higher production and will help keep a lid on prices really elevating significantly.
So that sounds much more like a longer term situation potentially for some of the oil companies, because in the short term, they don't want to drill endlessly, right? Because they want to keep their profit margins intact. Is that a fair way to look at it?
That's exactly the way to look at it, Julie. I think what energy companies are ultimately doing is they're balancing. They're looking for that Goldilocks scenario where they can balance the interests of their shareholders and their stakeholders and the shareholders with obviously keeping energy demand globally, and the consumer buying buying energy products, which basically means GDP needs to go higher. So if they can balance those two well, that's kind of that Goldilocks perfect scenario. But energy companies like Exxon and Chevron and a lot of others have big dividend yields. So if you have investors out there looking for big dividend yields and steady and growing dividends, Exxon, Chevron, and a bunch of other names are really good places to look at in the energy sector.
Rob, another headline that I saw this week, which is right in your universe, came from Axios. And this week, Rob, they talked about how Trump and his advisors plan to fairly quickly return to applying, in their words, maximum pressure on Iran. Military options not off the table, according to that report. I'm just curious how the conflict, the tension with Iran, geopolitics, how that is playing, Rob, into your oil outlook in 2025.
Yeah, Josh, I think that's part of the reason why you've seen oil ended the year and here in the U.S. around $68 a barrel. It's run up to 75 fairly quickly here to start the year. Has nothing to do with the weather. It basically has everything to do with, in my opinion, this concern about what's going to happen with Iran. So if you sanction Iran, then and actually apply the sanctions, you're going to have basically less oil supply, because the result will be lower exports of crude oil from Iran, which basically takes supply off of the market. Now, this oil market right now is already fairly tight. Now, doesn't mean the prices are going to skyrocket, because there is available supply, I guess available, whether it's U.S. production or, more importantly, OPEC Plus, that could bring back some production. So I'm not really worried about prices spiking a lot, but taking supply off the market will have a short-term impact on oil prices, and that means probably oil prices jump up a bit.
Rob, thanks a lot. Appreciate it.
Thank you.
Now, for some of today's top trending tickers, you can scan the QR code below to check out the best, worst, and most food stocks of the session on Yahoo Finance's trending tickers page. First up, a look at quantum stocks. They are all over that trending tickers page. NVIDIA's CEO Jensen Huang tamping down expectations on the quantum computing space. He basically said, we're 20 years away from very useful applications for this. He said this at an analyst event. But we kind of already knew this, right? Mm-hmm. This is something, when we first saw the quantum computing stuff percolate, it was sort of clear that it wasn't going to be ready for prime time for a while. But But I guess when somebody like that says it,
When
we'll
Jensen
pay
says
attention.
it, the quote is, if you said 15 years for very useful quantum computers, Jensen's saying, that would probably be on the early side. If you said 30, it's probably on the late side. But if you pick 20, I think a whole bunch of us would believe it. Did say he thinks NVIDIA is going to play a very significant part in this tech, wants to help the industry get there as fast as possible. But to your point, and listen, these stocks have made big moves. And there's different reasons for that. I think the Google Willow chip news that we talked about, Julie, certainly played a role there. But I think what he's getting at here, lots of excitement, lots of interest, lots of potential. But if you're looking for actual real world use cases, it could be a while.
It's not happening yet, but to your point, the stocks have soared incredibly. We're talking triple-digit gains, if not more, for many of them. So it's sort of a come down from those levels. And there has been a lot of news. Besides Google Willow, there was also a reactivation of a bill potentially that fosters quantum computing investment. AWS launched an advisory service linked to quantum. So there's been a lot of developments on this front that has sent those stocks higher before today.
For sure thing. Let's take a look at another movie here today. It's eBay. Look at that, nice 9% pop there. Shares of the company rising. That's after Meta says it will allow some eBay listings to show up on Facebook Marketplace. So this one's interesting, Julie. Per reports, I was just reading through it. So Meta will offer to publish listings from classified ads rival eBay on Facebook Marketplace. It looks like in terms of rollout, the test in Germany, France, and the US, and it's going to let buyers browse listings from eBay directly on Facebook Marketplace while completing their transactions on eBay. It sounds like this is really an attempt to comply with this EU antitrust order from November.
Yeah, they're not doing it out of the goodness of their hearts, right? This is because of that order. They also paid more than $800 million fine as part of that. So now doing this, but the company came out with a blog post and they said they still disagree with this EU decision and they plan to appeal it. So eBay investors maybe shouldn't get used to that, or they should keep an eye on the outcome of that appeal. But in the meantime, those eBay shares are at their highest since November of 2021.
I did see Con Sebastian over at Baird says that it covers eBay, says the Facebook Marketplace integration could drive incremental volumes. Still, Lexus One has an outperform.
And lastly, let's look at shares of Boston Scientific. That company announcing an agreement to acquire Bolt Medical, the acquisition to expand Boston Scientific's cardiovascular portfolio. Okay, you ready for some fun medical terminology? Yes. Intravascular lithotripsy.
Rolls right off the tongue.
Lithotripsy.
Yes.
Basically, it's a way of breaking down arteriosclerosis in blood vessels. That's calcified deposits. It's a newer technology of doing that, and it's supposed to be less invasive. It's not actually approved yet from this company, Bolt, but they're working on it, and there already is some competition in this sector.
Analyst at Bloomberg, by the way, weighed in, said Boston Scientific is well positioned to maintain its long-term sales growth outlook with the acquisition of Bolt Medical. A play here, to your point, they say, on that sort of what they call next high growth cardio market.
Intravascular, IVL is what it's called for short. That's a lot easier.
So much easier.
Yeah.
Coming up, it is the latest edition of our series Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're looking at semiconductor names as chip stocks can continue to come into focus amid the annual CES Tech event. I'm here with Granite Shares founder and CEO Will Ryan. Good to see you, Will. Thanks for being here.
Thank you, Julie. Good to see you.
So let's get to your buy first of all, and that is Micron. Micron actually got a little bit of a pop from CES, which we'll talk about in a moment. Over the last year, it's kind of muddled along, right? It hit its high back in June, as we can see, and then has come down since then. So let's get to why you like it. And the share's not only down since then, but also more recently in December came out with some negative guidance, and the shares are down since then. So do you think they've sort of unfairly sold off?
Yeah, I think this is a classic example of one of the names which has not hit the bright lights of the AI story. And when we think about the AI names that are leading the pack, this is not one of the names that jumps to the top of that. And that's been reflected in the share price. There was a bit of disappointment, obviously, the last earnings call where the company missed earnings and then guided down. But I think that is going to start to change.
Okay, so let's talk about some of the catalysts that could change it. Even though the bright lights of AI have not shined on it, the brightest light of AI, NVIDIA, kind of shined on it during CES, because hinted that Micron is working with NVIDIA, right?
And in a major way. So in the NVIDIA keynote, Micron was name-checked not only as a provider for some of the main processing technology which NVIDIA has, but some of its new memory architecture also going to be very important for NVIDIA's processing going forward. So much so that this is a keynote that's been shared very widely online, including by Elon Musk himself on X. So the company got a lot of, I think, eyeballs on it from that. And I think that the outlook for the company longer term is certainly strong. I think this memory part of the AI market that they're in is something that the company itself expects to grow pretty dramatically over the next few years. But certainly a name now that with working with the biggest player in the market, the godfather of AI himself, Jensen Huang, then the company's well positioned for the future.
And it's been sort of overlooked in that space. I mean, I should say memory chips are sort of traditionally the less sexy part of the semiconductor market, right? They're in a market that's already commoditized, they're probably seen as the more commoditized part of it. So it sort of explains why it's been overlooked here. But what do you think is going to change in 2025?
I think just if you looked at the NVIDIA keynote, I mean, the fact that one, they're working in partnership with the leader or the leading stock, certainly in the AI space, number one. But number two, that memory space is something that is expected to grow. It's a key component, a lot of the now NVIDIA architecture. So for me, the market, I think, from Micron's perspective and the memory space is expected to grow from 16 billion to 100 over the next few years. But more than that, I think now this is a player that can establish itself as one of the key AI stocks going forward.
And when we talk about potential risks here, it could be that maybe they continue to miss the numbers. What is the likelihood of that, do you think?
I think there's certainly the shorter term volatility, and that's what we've been seeing over the last sort of 12 months or so, with the name not being as sort of focused on by the investor community as some of the bigger names that we're all familiar with. However, I think the longer term, that the outlook is bright for the company. So short term, maybe could be some more volatility, but expect that to grow over time.
And is this a stock that you own, I should ask?
It's not a stock that I own personally.
Okay,
no.
Gotcha. All right, so let's get to the stock that you think folks should avoid, and that is Intel, very much the other side of the coin here. We know the shares are down sharply over the past year, and whoops, we're going back to Micron. Where's Intel? There it is. It's losing market share to competitors. We've seen that sort of play out over the past couple of years.
Yeah, this is a sort of a slow rolling tragedy in many ways of a company that once had dominant position in the chip market, very much the sort of the bellwether in many ways of the technology world, the Intel Inside, et cetera, that everybody's very familiar with. And just over time has really been late to various key things, most importantly, the AI boom, and has seen its market share erode over time, and hence the share price has just slowly deteriorated.
And of course, we know that Pat Gelsinger was just ousted as CEO after trying to bring the company back from that brink. And it's sort of, there are a lot of questions about what happens now, right?
a lot of questions, and hence part of the reason why he's no longer with the company. The company's received a lot of government funding. They have a lot of potential projects sort of going on at the same time. And really, I think it's about prioritizing for the long-term future. As we talked about, the losing market share to key competitors such as AMD, markets that they had a lock on, for such a long time. And so with that, it's difficult right now to talk, in a very positive way about the story.
When we talk about the future also, those projects you were talking about, it's foundry business where it would make chips for other chip makers. Some of that is contingent on these big factories it's building with help from the CHIPS Act. And so there's some questions, I guess, around that too.
Yeah, and this was meant just to purely highlight the fact that the company has been a big beneficiary of government funding, whether it's been through the CHIPS Act, whether it's been through the Inflation Reduction Act, something that President Trump has talked negatively about both of those things, threatening in some cases to repeal them. So it was really just some uncertainty over the fact that the company has benefited a lot from government funding. There may be some uncertainty about that under a new Trump administration.
What would be the better case scenario for an Intel here? Maybe they get some new leadership.
Yeah, it has to be the classic turnaround story. So that clearly starts with appointing a new CEO, having a growth strategy or returning to growth. But I think that there are a lot of issues at the company that need to be worked through. But clearly a start would be a new CEO, a new strategy.
We'll see. It's going to be a big year for Intel. We'll see how that all plays out. Thank you so much for being here, Will. Appreciate it. Thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
Let's check in on a few other stocks that are trending today. Shares of Instacart are moving higher. That coming after news that the company would join the S&P Mid-Cap 400 Index. So that is the news, to join that index before trading opens January 14th, it looks like. Stock enjoyed a just strong, remarkable move here. It's up more than 90% over the past 12 months. CEO here really has a strategy of the company, is kind of an e-commerce tech for supermarkets. How confident, though, Julie, is the street right now on this name and whether you should buy? They're actually kind of split. If you just look where they are, I've got 14 buys, 17 holds.
We talk all the time about how dead the IPO market has been, yada, yada. I mean, this is a company that came public in 2023, $30 a share, September of that year, and has performed decently, right? So it came public at 30, it's trading around 45 right now. So it's actually sort of a rare success story, I think you could say, for an IPO over the past couple of years.
Yeah, pandemic darling surged. Everybody was using it. Now the CEO does have a kind of vision and strategy where she wants to take it next.
Yes, we'll see how it goes. All right, and Constellation Energy, that stock is moving in the opposite direction, down about 5%. It's nearing a $30 billion deal for energy company Calpine. That is according to reporting from Bloomberg here. Now, Calpine, for those of us who've been doing this for a little while, the name is familiar from the Enron era, actually, in the financial crisis era, because it went under at that point in time, then came back to public markets, then was bought, then was taken private. And this is a power generation company, uses geothermal, among other things, as power generation. And so now Constellation reportedly interested. By the way, Constellation declined to comment on this report, so we'll have to see if it gets confirmed.
Bloomberg, citing sources, could value the company around $30 billion, including debt. I mean, we'll see whether it really gets done. That would be one of the biggest deals in the power generation sector, for sure.
Yes, it would. So we'll see what ends up happening. It's been a big deal, a big year, I should say, 2024, in terms of demand for power, and is expected to increase even more because of data center demand.
Moving on, according to New York's Office of Cannabis Management, the Empire State will see the number of legal marijuana shops more than double in 2025, from 275 to over 625, with sales reaching $1.5 billion. Despite the growth in support for legalization here, all-time highs here, marijuana status on a federal level has barely changed to the 1970s, creating uncertainty when it comes to cannabis stocks and ETFs. Could this finally be the year that changes? Well, joining us now is Dan Ahrens, Advisor Shares Pure U.S. Cannabis ETF Portfolio Manager. Dan, it's good to see you. So maybe start with kind of the price action, Dan, we've seen in some of these names and some of these ETFs. You look at MJ, the Amplify Alternative Harvest ETF, Dan, that's down about 35% over the past 12 months. MSOS, your ETF down about 50%. What explains these moves, and what do you think gets us out of that? What's the catalyst to move us higher?
Sure. Well, our fund, MSOS, is by far the largest cannabis ETF out there, but it focuses strictly on the United States. And very simply, we've been waiting for 4 years or more on a lot of politicians' empty promises. We keep expecting federal reform. We keep getting promised federal reform. And when we had this past election, these cannabis stocks took yet another hit because the investing public out there really thinks that the Republican Party is bad for cannabis. The Democratic Party would have been good for cannabis. But once again, a lot of people in our space feel like we've just been gaslighted for the past 4 years by Democrats' empty promises. Right now, sentiment is really at an all-time low. People think we're just going to wait more, nothing's going to happen. But at the same time, there's a lot of pieces in motion right now.
Well,
there's hearings in place to have a rescheduling process, among other things.
Well, Dan, is it just a problem of picking the wrong horse? I mean, I look across so many different industries. I look at banks. I look at crypto, right? I look at a lot of industries that poured a lot of money into Republican candidates this cycle, and it seems like it's paying off for them. Is that why isn't cannabis getting some of that love? Is it a lack of lobbying effort on the part of your industry in the right direction?
Lobbying is certainly one piece of it. There are people that are working in Washington. There's people that are in the ear of the Trump administration. But when you're comparing the cannabis industry to banking or pharmaceuticals and other large, substantial industries, it's really nickel and dime in an uphill battle. Now, I can't say that cannabis is an important issue to the Trump administration, but Trump came out in the fall with some messaging that was in support of the amendment in Florida. He was going to vote yes for adult use in Florida. He mentioned the fact that we should have banking for cannabis, that we should have exchange listing for cannabis. When you talk about Trump's view towards cannabis, and then you throw in RFK and people that are in his ear like Vivek and Elon Musk, there is an awful lot of support, even though these are Republicans, an awful lot of support to finally fix the business side of cannabis. And I feel a little bit like the boy who cried wolf because we've been expecting this. But now in 2025, with prices at a low and sentiment at a low, we really could, but I got to be careful saying this, see a very positive year in 2025 because this rescheduling, the DEA Schedule 1, moving it to a Schedule 3 drug, has all sorts of huge implications that are very positive for these U.S. cannabis companies.
You know, Dan, talking about the incoming Trump administration, you mentioned Trump there, of course, and RFK. From what I understand, though, Dan, to put another name out there, Trump's pick for AG, Pam Bondi, she is not such a great friend and supporter of your industry. Am I wrong on that?
I would say more wrong than right, but it's a gray area to say the least. She's coming from Florida. Florida has by far the largest, the strongest medical cannabis market in the world. And we nearly had a 60% positive vote for adult use in Florida, but it failed. It did fail, even though Trump showed support for it. But it had well over 55% of the popular vote in Florida. So again, Pam Bondi was in Florida. There's a lot of support for a strong cannabis market in Florida. And an important thing here to understand, no one that's in this space is really talking about wanting a federal full legalization. Again, it would be nice to have maybe someday, but what we're looking at is partial legalization. I believe that we need fair and equal banking for these cannabis companies. These cannabis companies that operate in the U.S. and employ hundreds of thousands of Americans need to be able to list on U.S. exchanges. Right now, they list on secondary exchanges in Canada and then trade OTC in the United States, while Canadian operators, in many cases, are allowed to list on the New York Stock Exchange or Nasdaq. It's a very unfair situation. So, and we have, I think, 39 states now. The number keeps changing. States that have medical cannabis markets operating legally on a state-by-state basis. And we have 24 of the 50 states that have adult use approvals in the United States. So what we need is simply banking. We need these companies to be able to operate legally in the United States on a state-by-state basis without being contrary to federal law. And we think this rescheduling will cause a domino effect in the future that may cause banking, may cause uplisting. And the rescheduling that I already dropped a few times here,
Right.
it is a big boon to the bottom line of these U.S. cannabis companies, because right now they're taxed like drug traffickers. They cannot deduct any business expenses.
Right.
It's called 280E taxes, very unfair. And the administrative law judge hearing process, it's already in motion right now. The
Well,
U.S.
Dan,
is recommending it without Congress.
Well, Dan, we'll have to see if anything changes in the coming year, and we'll catch back up with you. Appreciate it.
Thank you.
Stick around, much more market domination still to come.
As artificial intelligence enters another new year of evolution, more and more employees are using AI at work. Accenture releasing a new report on AI saying that more than 40% of employees have used it in the last 6 months, but they're also afraid of admitting it out of fear that using the new technology makes them seem replaceable. Joining us now is Lan Guan, Chief AI Officer at Accenture. Lan, it's good to see you. Maybe start with that stat, Lan, which is interesting. So more than 40% of employees have used AI in the last 6 months. Do we have line of sight there, Lan? Which employees, which sectors, which industries, what are they using it for?
So very proud of this research that we just released, and I will answer that question, by giving two examples. In Accenture, right, we are an early adopter of Gen AI, and we have implemented this kind of AI projects across multiple, business corporate functions that we have. Like for example, in marketing, now we have our marketers are using Gen AI to do campaign management, to do strategic planning of the campaigns, to do this kind of end-to-end execution of the campaigns. So we have a lot of examples like that. And also, on the market side, I work with our clients cross industry every day. We work with the insurance clients, help the insurers to use Gen AI to do, for example, claim processing, so that the insurance agents will be able to use the language understanding capabilities from the AI to understand all kinds of regulatory requirements for different insurance assets, so that they can better serve the customers, and provide better quality to the end customers.
Lon, there seemed to be this sort of mantra by the industry maybe a year ago when this was really first starting to be incorporated, that it would not cause necessarily the significant loss of jobs. It would augment people, right? That doesn't necessarily seem to be holding up in terms of how we're seeing it play out. We've seen examples of companies that at the very least have not hired as many people because they've been able to use Gen AI. So how are you thinking about this issue, and how are your clients thinking about this issue?
Yeah, I think the how humans and AI working together in the future, in the age of Gen AI, this is a hot topic that I'm talking to my clients all the time. And I do believe, even with the most advanced technology, for Gen AI, things like AI agents, things like more advanced models, reasoning models from our ecosystem partners, the future is going to be, a very cohesive way of humans and AIs working together. In fact, I'm super excited about this industry agent solutions that we just launched here at CES yesterday. So initially there are 12 industry agent solutions that we are taking to different industries, things like healthcare, consumer goods, different examples. But in that case, each of them, right, you can think about we are creating a squad of digital assistant, right? A squad of AI agents. So all these agents are actually working side by side employees, right? So that these human employees can become superhuman, and they will be able to, for example, orchestrate a team of AI research assistant. And this is a type of agents that will be focusing on specializing in doing research work, right? By pulling data from all over the place. And maybe there's another type of agents that will be focusing on doing the forecasting, right? Based on the all kinds of market trends. So to me, this is the future that we are very much looking forward to. It's about using AI agents. It's about using the most cutting edge technology to make humans more empowered. So that I think, at least from my perspective, I think the putting humans into everything we do, putting human in the center of AI is our key guiding principle.
Lon, the examples you're giving there, does that mean, looking ahead, perhaps I'm not worried about AI taking my job, but maybe I am a bit worried about somebody who learns how to use AI and leverage AI taking my job?
I think that's to me that maybe that explains a lot of demand that I'm getting. A lot of my clients are reaching out and say, okay, can you come in to teach us AI? Can you come in to help me transform my workforce so that this kind of impact, my employees, each of them, every single of them, every function, right? They can be part of this AI revolution. I have to think that that's a part of the reason.
Lon, thank you so much. Appreciate your time.
Great.
And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it's market domination overtime. Let's see where the major averages ended the session. All three of the green, but time has made a liar out of me because the Nasdaq just dropping into the red in the last few moments of trading. The Dow higher by 106 today, up about 0.2%, but a very volatile session within a pretty narrow range as investors were digesting some comments, a report early this morning about how President-elect Trump perhaps plans to institute tariffs through an emergency economic declaration. And then, of course, continuing to keep a very sharp eye on bond yields and on the U.S. dollar. That's where the investors investors we're talking to seem to be taking some of their cues. The S&P 500 also finishing higher, but a very similar pattern throughout the day. And then the Nasdaq was indeed the loser on the day, so falling not even 0.1%. So not a very large move here. But as we look at the 10-year, ending just shy of 4.7%. And as we looked at how this percolated through the various sectors here, communication service is the worst performer along with tech, so continuing to show that sort of yield sensitivity with bond yields at these levels for large cap tech. And then we had healthcare and materials and industrials on the plus side today. So a pretty mixed bag in terms of the movement from the groups. The Nasdaq, looking at the groups there, NVIDIA down just a smidge on the day after the selling that we saw yesterday. But here too, kind of a mixed bag. Got today off for stock investors and then back on Friday with the jobs report. And speaking of the jobs report, one piece of economic data that we got today, the ADP jobs report coming in below estimates. So there's not a one-to-one correlation, certainly with Friday's report, but something else that traders were watching to take their cues from today.
All right, Julie. Stocks wobbling on Wall Street today, closing the day a little changed, but the worst performer was, in fact, the Russell 2000, down more than 0.5% there. But our next guest says don't ignore small cap stocks in 2025. And joining us now is Nancy Pryl, Essex Investment Management co-CEO and senior portfolio manager. Nancy, it's good to see you. So let's talk about those small caps, Nancy, which is an area you spend a lot of time thinking about. I have to tell you, Nancy, and Julie can confirm this, throughout 2024, we had a lot of strategists come on this show, banging the table, Nancy, for those small caps. Ended today in the red. They're down about 7% in the past month, Nancy. What about 2025? Am I going to regret not owning those pint-sized companies?
We think you will regret not owning them. We know it's been a very tough slog. Clearly, small caps are out of favor. We've had about 14 years of underperformance of small caps versus large caps. And so one might say, why do I care? Why should I care? The reason comes down to a combination of valuation, which we have had for a while and has been important, but not enough to get the sector moving, but equally, or perhaps more importantly, earnings growth. And what we see happening this year is an environment where earnings growth is broadening, not just small cap versus large cap, but even within large cap. It's no longer going to be a world that's just the Mag 7 driving earnings growth, but it's going to be across many other sectors and also down market cap. We expect earnings growth in the Russell 2000 this year could be above 15%, which will be at least competitive, and we think actually above what the S&P will show. And those two conditions are what will turn this somewhat historic underperformance cycle around. I'd also note there have been 4 underperformance cycles similar to this one in going back almost 100 years. And in each case, as the sector was left for dead, it came back very, very strongly with a really strong upcycle.
Nancy, at one point, the bullish case around small caps really hinged on rates coming down, right? And we know that the outlook for rates coming down has changed quite a bit. How much of an obstacle is that going to be, though, when we're looking at, even if you've got the earnings wind at your backs, on a comparable basis, if investors are weighing large to small, won't that lack of rate cuts be a headwind?
We don't think we need rate cuts as much as we do need rate stabilization. So I will agree that if the 10-year is going to continue to go up and is going to reach something, 6-7%, that's going to be a headwind, not only to small caps, that's going to be a headwind to the market overall. Because that would be an environment where inflation is coming back, and so multiples are going to get compressed. However, with rates in the kind of 4.5% to 5% rate, I'm talking about the 10-year here, that's an environment where small caps have prospered in the past, and we believe they can prosper as well this time, particularly because the current environment for rates, the reason rates are strong is because the economy is strong, and the areas where the economy is strongest are those that really benefit companies that do most of their manufacturing here in the U.S., and that happens to be small cap stocks.
So let's look into sectors, Nancy. Which sectors do I want to be overweight in 2025?
Right. So clearly we want to be overweight in industrials in 2025. When we think about the big growth drivers out there for the economy overall, we can think about things like reshoring of manufacturing, building out our power infrastructure, building out data centers to support all of the work that's being done in artificial intelligence, building some energy infrastructure, repairing roads, bridges, ports, et cetera, particularly in a climate change world. I'm sure you've been talking about the wildfires today. We need a lot of infrastructure rebuilding. That all comes down to industrial stocks that will help support those trends. We also want to be overweight in certain aspects of technology. Again, those building blocks to use AI, whether they're semiconductors, whether they're software companies that will provide the use cases for AI. And then thirdly, healthcare. Healthcare is a sector that has not been a good place to be, but there's tremendous innovation going on there. It is one of the biggest beneficiaries of AI, and we think it's a place that is poised for outperformance this year.
And Nancy, let's talk about some individual picks within those sort of sector and thematic umbrellas that you were talking about. And again, this is on the small cap side. So on the industrial front, Arcosa is one of the companies that you like, an infrastructure construction company. This is actually a spin out of Trinity. So where does it fit into the themes that you were talking about?
Well, so it fits very squarely in those themes of reshoring of manufacturing in America, rebuilding of roads and bridges. They have a cement business that is a big part of their business, and also the rebuilding and the enhancement of our power grid, which again is so vitally important. Arcosa is a way to play at all three. We like spin-outs in general because these are companies that are now able to focus on their operations, improve their balance sheet, improve their margins, and that's exactly what Arcosa is doing.
Nancy, a final ticker I wanted to get your thoughts on. It's a name you like, Pegasystems, ticker PEGA. This one has already soared higher, Nancy. It's up more than 100% in the past 12 months. Do you stick with it?
We do think you stick with it. Again, I talked about AI, and what we're looking for today really are the use cases for AI. Those software and services companies that are taking the power of our AI and harnessing it to drive productivity enhancements. Pegasystems is a way to do that within the customer relationship management space. It's agentic AI, which I'm sure you've been hearing people talk about, the use of AI to enhance what your sales reps, what your customer service reps can do. They are just at the beginning with some new products that they've launched, and we think they have a lot of runway ahead of them.
And Nancy, when we talk about the other umbrella, I like to talk to also, since we talk about semiconductor adjacent companies. So talk to us about that one.
Right. So Ambarella, it's machine vision. So it's adjacent to the AI play, but it's very much a play both in automobiles with autonomous driving, which we know what's going on with Waymo, with Uber, with Tesla. Autonomous driving is coming. It may not be fully autonomous, but you need machine vision even for, you know, those automatic parking systems that we're all going to get in our cars. And it's also robotics. Robotics, whether it's for industrial manufacturing robotics, which is a way to both increase productivity and solve some of the employment problems. And then ultimately, and this isn't immediate, but ultimately robotics, personal robotics, if you will. You can think of, we can all have our own personal robot who might be able to do our laundry, load our dishwasher, et cetera, in our home. It's not here today, but it will be at some point in the future.
Nancy, thanks for your time. Appreciate it.
Thank you.
We are also following the devastating wildfires in Southern California. There are at least 3 separate fires now raging around Los Angeles, fueled by powerful Santa Ana winds. More than 70,000 residents are under evacuation orders, and officials say the Pacific Palisades fire is the most destructive in LA history, with 1,000 structures destroyed. Roughly 400,000 people are without power, and the concerns are weighing on shares of utility companies in California. One of the biggest movers is Edison International, whose Southern California Edison is the main power utility for areas surrounding Los Angeles. And despite these declines, there's no evidence as of now that links the utility to the fires. But in previous fires in Northern California, the local utility there, PG&E, was found liable. We'll be right back. The Federal Reserve revealing in its December meeting minutes that officials are worried about inflation and the likely effects from changes to trade and immigration policies. The concerns highlight the debate on how the Fed will move forward with its rate cuts. Fed's Chris Waller recently reaffirming his support for cutting interest rates this year despite Trump's tariff talk. Investors can expect to hear additional commentary from more Fed officials on Thursday, including the Fed's Patrick Harker, Susan Collins, Tom Barkin, Jeffrey Schmidt, and Michelle Bowman. It'll be busy. Here with a closer look at the state of the Fed and its monetary policy is Serpa Pinto Advisory founder John Hilsenrath. John, thanks for being here.
Great to be here. Thank you. That's a long list of
Yes, it is. But it was interesting to see in the minutes that many of the Fed members did sort of model a baseline for what fiscal policy is going to look like and sort of worked that into their models. But many of them seemed content to that now pausing was going to begin.
Well, I mean, and I think that's the key message that comes out of the minutes is that they said pretty clearly that they mostly agreed that once they cut rates in December, it's time to pause, and they want to see how things play out. There's a couple things going on. You mentioned there's a lot of uncertainty about fiscal policy. There's a lot of uncertainty about tariffs. There's all kinds of uncertainty about what a Trump policy will look like. But even before that, we were seeing signs in the final months of 2024 that inflation was a little more stubborn than they had penciled in. So even before you start factoring in those uncertainties, there's some reason. I didn't think they needed to cut rates in December. I thought the time to pause was in December. You mentioned Waller is interesting because the market seems to hang on what he says. He's the one who kind of set a dovish tone going into that December meeting, and then the Fed ended up following through on what he said he wanted to do. I think you got to be careful putting too much weight on his dovishness this time.
Although I meant to ask you about Waller, John, because there was this interesting storyline that's developed around Waller, and some folks are actually asking, is Governor Waller kind of jockeying here in their words to be the next Fed head, the next Fed chair? And they're kind of pointing, Trump comes out, says, hey, rates are too high. Waller comes out, says, you know what, maybe more cuts are appropriate. Do you give any weight to that storyline?
Not only that, there was talk last year about maybe Trump announces who the next chairman is going to be a year or two in advance to create his own shadow open market committee. I don't know. I mean, it's hard to say about all that. I mean, what I can say right now is that Jay Powell is in charge. I would be careful about putting too much weight on what Waller says should happen at the next meeting or the meeting after that. And I think the market got caught off guard a little bit because Waller was right. They went ahead and kept rates in December, but they also had a really hawkish tone. And I think people maybe put too much weight on Waller's dovishness.
Now, as you said, the backdrop is already not fantastic. You know, even before we get this fiscal policy, we saw inflation creeping back up. We've seen bond yields really creep up.
Right.
How closely is the Fed watching the market reaction to this latest inflation data?
Well, I mean, they're watching all of this. I mean, I think it's really the inflation data that's going to drive the story at the end of the day. They can't control long-term interest rates. They can't be targeting stock prices, certainly not Bitcoin. What's going to surprise the markets or move the markets and move the Fed in the end is whether the inflation data resume their decline to 2%. Or steady out above 2.5%. If the inflation data don't resume that decline to 2%, then the Fed's on hold. I mean, I think it's that simple for the Fed. They have a target, it's 2%, and they got to get there, and they can't keep cutting rates if it looks like that process is stalled. And there was talk about stalling in these minutes.
John, Nick Timmeros over the Journal, your old stomping grounds, had a great column. Nick's columns are always great. And he was talking about how Powell finds himself in this familiar position where he's walking again this sort of tightrope. And he doesn't want to seem like he's fighting Trump, right? Yeah. He doesn't want to confront Trump. He doesn't need that. Yeah. Even though Nick's point is, even though at the same time his colleagues, or at least some of them, clearly getting uneasy that Trump's policies now rekindle inflationary pressures. How does this tightrope kind of evolve from there?
I'm getting a sense of deja vu all over again because I worked with Nick on those stories in 2017 when we were talking about the Powell playbook for a Trump presidency. And the playbook was very clearly that, he wasn't going to talk about Trump. He wasn't going to get involved in political arguments. He was going to stay focused on the data and the Fed's mission. And I think he's going to bring out that playbook. That's his playbook for the next couple of years. In that context, though, it was interesting that just this week, the vice chair at the Fed for Supervision, Michael Barr, stepped down from his position. So on the one hand, when it comes to monetary policy, the Fed will always talk about its independence. Jay Powell will say his mandate is 2% inflation, stable job market, rule out, kind of focus out the politics. But on supervision and bank regulation, that's something where they have to work with the new administration. It has to have a say. And so I think people were a little surprised that supervision folded his card, that Michael Barr folded his cards as quickly as he did.
Do you think that the playbook from Powell will work again?
Well, I mean, it'll work for the next, it's harder this time for a couple of reasons. I mean, I think it will be his playbook for the next couple of years, right? Focus on the data, focus on your mission, don't engage in politics. But there's some complications. First of all, when you don't engage in politics, you have to respond to economic policies that will affect the economies, whether the economy stays on track or not. So you can't totally rule out what Trump does, that's one. But the other thing is, we know Powell is going to be gone in a couple of years, right? Powell wants to be gone in a couple of years. So then you get into these things, these questions where, well, all right, so the Fed is making forecasts for what the economy is going to look like and what rates are going to be 3 years from now. Do those forecasts mean anything if there's going to be a whole new Fed chair and a whole new kind of regime 3 years from now? What are those, the dot plot? Does it even matter looking out beyond another year or two? I mean, I think those kinds of issues are going to complicate Jay Powell's life.
Yeah.
Complicated, more drama. John, we'll bring you back to discuss it.
We also need to talk more about those 10-year yields, but we could do that next time.
I'm sure
that's
they'll still be
a huge
moving.
story.
Yeah, for sure.
John, great to have you on set. Appreciate it.
Thank you. Yeah, I appreciate it.
Time now for what to watch. The stock market is closed tomorrow for a national day of mourning. The closures are in observance of former President Jimmy Carter's funeral in Washington, D.C. The bond market will be open, but is closing early at 2 p.m. Eastern.
And moving over to the Federal Reserve, we will be getting a big batch of Fed commentary tomorrow throughout the day. This came after some comments this week from Fed Governors Christopher Waller and Lisa Cook. Waller saying today more cuts are likely, but the timing does depend on inflation progress. And Cook said Monday that Fed officials could be more cautious with cutting interest rates.
And looking ahead now to Friday, the monthly jobs report for December is coming out at 8:30 a.m. Eastern. Economists expect non-farm payrolls to rise by 165,000 jobs in December, while unemployment holds steady at 4.2%, and month-over-month hourly wage growth slows to 0.3%.
And finally, we got some more earnings coming on Friday as well. Delta, Constellation Brands, and Tilray will all report on Friday morning. Delta will announce fourth quarter and full year results for 2024. Analysts there expect the airline's fourth quarter earnings to gain, with lower fuel prices offsetting higher wages.
And coming up on the latest episode of the Yahoo Finance podcast, Living Not So Fabulously, hosts David and John Ottenschneider spoke with Jadis Montijo about his journey failing forward as an entrepreneur. Be sure to scan the QR code below to stay up to date with all the episodes and tune into Living Not So Fabulously every Wednesday at noon Eastern. Here's a look at today's episode.
We went through a really long due diligence process, and a lot of that was because in the beginning of KindPen, Anthony and I didn't really know what we were doing. Like, we never started a business before, so we were just kind of doing whatever we could and what seemed right at the time. So during the due diligence process, 6 years later, there's a lot of cleaning up that we had to do, which took a long time. And in the middle of that, some really bad industry news came out when we were really close to closing, actually. So bad industry news came out. People were dying from vaporizers. There was that popcorn lung, and we made those products for people to smoke out of.
Yeah.
So the company that was going to acquire us, they ended up pulling out of the deal.
Backed out.
Yeah.
So then, what was the state of your personal finances at that time?
In shambles.
So what did that mean for you then when that fell through?
I mean, it meant a lot of hiding under my sheets and trying to collect myself mentally. But we had to go back at it. At the end of the day, whether the acquisition went through or not, the business still had to keep running, which I feel like, even looking back, like we spent so much time with the anticipation of that acquisition being successful that we've really stopped even focusing on growing the company at that point. We're just like, what do we have to do to get this company into the acquirer's hands? So we weren't really working on the business. So we really had to just come back to the drawing board. And especially now, not only were we not working on the business for so many months, but that business had such bad news surrounding it. We were like, what do we do? How do we keep this moving forward? So we had to figure that out.
Yeah, so it's two sides that are scary, both your personal side for your finances as well as the business financial side.
Yeah, of course.
That is really scary.
Yeah, I mean, when I was expecting us to be acquired, I was out having a really good time, not thinking that things would fall through, and spending money and enjoying myself, and I learned a hard lesson.
The answer probably seems pretty obvious, but if you had to do that over again, what would you do differently personally?
I would have definitely financially prepared myself a lot more, and I learned that nothing's guaranteed, and that's why you need to be prepared financially, personally. As much as you want your business to have that successful exit and you want it to be successful, there are so many variables that can really make it not happen and get to that point.
Right.
So having a plan B, essentially, or making sure that while you're building your business, that you're also setting yourself up personally within your finances in case of failure.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve, and the key trend policy, tariff policy under President-elect Trump. A mixed day for the markets, with President-elect Trump's recent comments on tariffs and possible U.S. expansion bringing back some of the volatility we saw during his first term in office. We're going to explore today's market trends. And speaking of Trump volatility, how much should investors expect in a second Trump administration? What form will it take? We're going to try to figure that out. Plus, if Donald Trump moves quickly on tariffs, lawsuits are sure to be right behind. We're going to break down the legal challenges the White House could face depending on the path they choose to implement the new tariffs. As I just mentioned, the new Trump administration is expected to move quickly on tariffs, and legal challenges are expected to follow. Joining us now to walk through all this is Yahoo Finance's Ben Worschel. Ben.
Hey, Josh. Yeah, so I wrote about the lawsuit side of this today because this is a pretty significant X factor, I think, for businesses and for investors. That'll be a big post-action, post-January 20th story. The reason to watch lawsuits closely is especially as if Trump moves on what's a 1977 law called the International Emergency Economic Powers Act, IEPA for short. And this is the sort of most muscular, most aggressive move he could he's seen as being able to make right out of the gate. There's one expert says that could mean tariffs in effect within 12 hours of doing this. This is immediate. You declare an economic emergency. There was a CNN report today that confirmed that this is still very much on the table, but this is something Trump aides have been talking about for a long time. It was even sort of toyed with in the first Trump administration, but not sort of gone at in full force. The upside for Trump, as I mentioned, fast and big, is that he could go fast and big on this. The downside for this is that this is a 1977 law that hasn't been legally tested, the tariff side of it at least. And so it would lead to a lot of challenges. So you can see a lot of groups from the Chamber of Commerce to Business Roundtable to sector-specific groups sending signs that that lawsuits could very well be in the offing, and that could inject a lot of uncertainty into it. This is all sort of you can't do a lawsuit until after the action is proposed. So this would have to be after Trump announces what he's going to do, and that's still very much under debate. But that'll sort of, just in case anyone was thinking that we'd have clarity on tariffs on January 20th or 21st, this will probably keep uncertainty going for quite a while.
Where, Ben, is Congress in all this discussion?
Congress is kind of on the sidelines of this. You know, the Constitution says Congress is in charge of this, but for decades now, this law was from 1977. There's a whole bunch more. Section 301, Section 232 are all these laws from the last 50 years, where Congress essentially gave the powers to the president in a lot of fronts on tariffs. So the Constitution says Congress should do it, but in reality, the president has a lot of unilateral authority here. And Trump has said he doesn't need Congress. He thinks Congress will approve it, and they can, but he has the power to act alone. So Congress has been on the sidelines. There's some folks on the Hill that I've talked to that are talking about jumping in, but that's an uphill battle for certain. Republicans would be less likely to kind of undermine their commander-in-chief on this and sort of try to take some power back at this moment for sure. That's the sense a little bit. It could come into play on taxes. Trump has talked about using tariffs to pay for taxes, so maybe Congress is open to giving him more authority there. But for right now, Congress is kind of on the sidelines. I think the early focus will be executive actions from the president-elect right off the bat, and then any legal action that responds to that.
What's really quickly, Ben, as you're talking, I'm just thinking through this. Let's say you had legal action. Is it possible you would have a judge step in and say, listen, I'm freezing implementation of these tariffs until we work through this case?
That's possible. Most folks think that's very unlikely. You'd have to get a very sympathetic judge to do this. There were lawsuits last time. These were on sort of different authorities and kind of less aggressive, and the judges did not. The lawsuits went forward, but the tariffs went forward at the same time, and then the lawsuits essentially petered out, and some were cast aside. So it is possible. You could see that where a judge says, we need to take a break at this. We need to freeze these. But most folks I've talked to suggest that's unlikely.
Ben, always great to see you and have you on the show. Thank you.
Good to see you.
With President-elect Trump reportedly considering a national economic emergency to enact proposed tariffs, we're looking at the ripple effects that could be in store for investors with Yahoo Finance's Alexandra Canal. Allie.
Hi, Josh. Yeah, a lot of noise right now when it comes to Trump's tariff plans, and we've seen the markets react pretty extremely to these various reports. But one area that I wanted to focus on is the U.S. dollar, because we've just seen this currency in rally mode over the past year. If you take a look at the U.S. dollar index, which measures the value of the dollar relative to 6 other foreign currencies, we're at levels that we haven't seen since November 2022. We're above 109. We're trading near 52-week highs. If we zone out and take a look at a year chart, we are up about 9% since the lows that we hit in September. And then right around the election, in November were up about 5%. So at this point, Bank of America is saying that the dollar is priced to perfection. They're estimating that it ended 2024 at 55-year highs. And if you think about why the price action has been so bullish, it's mostly due to two main catalysts. One is Trump's election win and the Republican sweep, and two is a recalibration of future Fed easing in the face of a lot of this strong economic data. So think better growth, equity market performance, higher yields. That all feeds into U.S. exceptionalism and acts as this magnet for attracting capital to the U.S. And even with data that isn't necessarily considered good for U.S. equities, think higher price pressures, inflation, that's something that actually benefits the U.S. dollar, because if inflation is high, that means the Fed is going to pull back on its easing policy. Blake Millard, who is the director of investments at Sandbox Financial Partners, he emphasized this point. He wrote in a note that with the Fed expected to cut rates less than most other major central banks, the interest rate differentials, they favor the U.S. dollar. And then on top of that, the tariffs enacted by Trump, if they go to fruition, that's going to restrict the flow of goods, and that will lead to fewer dollars going abroad, reducing the demand for foreign currency. So all of this signs that the dollar could continue to swing upward. Of course, there are risks like policy uncertainties, a deterioration of the U.S. economy. But for now, the dollar is trading at a key inflection point. And lastly, one thing I want to point out is that with a strong dollar, it can actually negatively impact companies with businesses overseas. And this was something that FactSet pointed out, because in the third quarter, companies with less than 50% of revenue in the U.S., that means they have a lot more exposure internationally, they contributed 14% to earnings growth in the third quarter. You compare that with companies more than 50% of revenue in the U.S., just 2%. So a stronger dollar coupled with blanket tariffs across the board, that could actually spell big trouble for stocks and big trouble for earnings growth, which, as we know, is a big catalyst for the market. So the dollar, very, very important to keep an eye on.
All right. Thank you, Allie. Appreciate it. Donald Trump isn't even back in the White House yet, but one message to investors is already coming through loud and clear. Expect a bumpy ride for the stock market. Joining us now is Tom Essay, Sevens Report research founder. Tom, it's good to see you. So let's start there, Tom. In your opinion, is that the message for investors? Trump is moving back into the White House, so expect a bumpy road ahead. Buckle up, get comfortable with volatility.
Hi, Josh. Thank you very much for having me on. Yeah, I think that's a reasonable expectation for everyone in the market. And I think that what's going to make that a bit tricky this year is we've just come out of one of the most not volatile years you or I or anybody else have seen in a really long time. So I think that that's going to change. It's already changed somewhat quickly. Now, the important thing for everybody watching at home to remember is that volatility doesn't mean that the stock market, goes down a lot either. So we can have a volatile market that still produces a decent return. It's just going to require us to pay a lot more attention, frankly, and to just kind of cut through the noise and see what's really mattering to this market.
And how do I cut through that noise, Tom? If you were here yesterday and we were talking, Tom, and we were talking Trump, we would have been talking Greenland and Panama Canal and something about the Gulf of America. I mean, how do, as an investor, do I try to distinguish between a headline that matters and one that's just noise or something in between?
So you've got to really stay focused on what's driving this market and what is driving this market. Well, first of all, economic growth is driving the market, right? Growth is good, and that's supporting the market. And as long as growth is good, then the fallout from all of these other things should be relatively contained. The Fed is driving the market. Now we're seeing a bit of wavering here, right? The market wants at least 2 rate cuts in 2025. Not exactly clear if we're going to get that. So that's adding a bit of volatility. Certainly economic expectations, policy expectations from the Trump administration is also driving the market. But of the 3 I just mentioned, that's the least important. For things like tariff headlines, here's what I want people to focus on. Look, there's going to be a million different stories about this and different ways that they may try and do things. At the end of the day, it's about the exclusions, right? So when Trump enacted tariffs in 2016, did anybody really notice? Not tremendously, because while there were tariffs, all the things that were really important were excluded. So unless we see sort of a lack of exclusions this time, then the tariffs could create great headlines, but they're not going to derail the market or the economy.
So is your bet, Tom, that ultimately Trump's tariff policies, they're more moderate, more orthodox than maybe the rhetoric suggests?
Yes, I think the market, and I agree with it, view the tariffs as a negotiating tool. And here's why I think that. Because Trump responds to the markets, right? If the market goes no bid on him doing universal tariffs and everybody getting extremely nervous, he will course correct because he is not going to want to sit there and preside over the erasing of this huge rally we've seen over the past 2 years. And I think that should give people some sense of confidence that while some of these headlines are bizarre, and this is what we get when we get Trump as a president, at the end of the day, he does follow the markets, and the markets will, I think, control him.
So is your message bottom line, Tom, then to investors, long-term investors who are listening now, you try to look through the headlines and stick to the fundamentals, its earnings, its valuations?
Yeah, I think you've got to cut through the policy mess. I mean, in the end, they're going to get something done to extend the tax cut. So that's a positive. It may take all year, but they're going to get it done. The bigger issue is the economy. The economy is the tide that lifts all boats and sinks all boats. So while the headlines will focus on Trump, as long as economic data is solid, we're going to be okay.
That's a good note to end on. It's positive. It's forward-thinking. Tom, I like it. Thank you for joining us.
Thank you, Jeff.
Stick around. Much more Ask for a Trend still to come. Well, U.S. stocks closed mixed for the trading day. Investors weighing a report of President-elect Trump considering declaring a national economic emergency to pave the way for proposed tariffs. Yahoo Finance's Josh Schaefer joins us now with the trading day takeaways. Josh.
Yeah, Josh, some more tariff news out today, reporting not necessarily what President-elect Trump is saying, but reporting from CNN, right? So I want to start there because, again, we were talking about this on Monday. We were looking at the U.S. dollar then, right? But today we'll use S&P 500 futures just to give you an idea of what the 2025 market feels like right now. So CNN comes out with this report. You can see futures were higher this morning. CNN comes out with this report. That's what happened to S&P 500 futures, right? And it sort of set the mood for the day, even when we go to the S&P 500 and look how things closed. Slightly up, but it really kind of hurt the mood where it felt like we might have had a little bit of a rebound day. And to me, that's just been the takeaway from this week with all this tariff back and forth, is right now we are in a clear moment where whatever is said about Trump policies before he gets into office, we just don't know about. And the market is not loving that uncertainty, and it's causing a little bit of volatility, a little bit of back and forth. And I think perhaps part of the reason why we haven't been able to get back above 6,000 for the S&P 500, it feels like every time you have a little bit of momentum, there's a new headline coming out about what could happen with policy this year, and it kind of halts your progress a little bit.
Yeah, we've just generally started the year with more volatility.
Yeah.
I know there's some folks, Josh, who pin it more on, they would pin it on yields like we've talked about. Technicians would pin it on short-term oversold conditions. But you're right, Trump too makes headlines. We've had folks on the program today, though, who would argue that, at least for a long-term investor, as hard as it is, your best bet there is to try to look through those headlines. Not to say you dismiss it, because the president-elect speaks, you have to take it seriously, but you try as you might, you want to stick to fundamentals.
Yeah, we were speaking to strategists about that yesterday too, Josh, right? The key question here being, it's always about earnings at the end of the day, right? The S&P 500 is expected to grow earnings at about 15% next year. Which of these policies and what level of policies would then impact that for the S&P 500? I think that's sort of the prevailing investor question that people should be asking themselves. Takeaway two here, 10-year finally crossed above 4.7%. So this has been a level we're watching, looking at maybe 4.75 too, for when it might just really have no resistance to head up to 5. Sorry, Josh, that is not the 10-year T-note. This is. So we closed below 4.7, but if we look at the intraday, here's where we got above it, right? And so again, we talked about tariffs. That's part of what's pushing this higher, but also just the general expectation in the market over the last 2 days that perhaps inflation might be stickier than we thought. You see this move up right around the Fed minutes is also when it stayed up above 4.7, came down a little bit, but the Fed minutes sort of also reiterating that point that maybe the Federal Reserve is a little bit more worried about what Trump's policies, specifically tariffs, mean for the inflation story. It said several officials talked about that during the meeting. And so a little bit more color there. Remember, after that press conference from Powell, he sort of mentioned that maybe they had talked about Trump's policies, but it seems like it was definitely a conversation there. And so the question being, once we get into the middle of the year, will the Fed become a lot more concerned about what tariffs mean for inflation? Will inflation have made enough progress? If it hasn't, maybe your 10-year stays here. And we've talked a decent amount at this point about how at 4.69, people think this is a headwind for equities until it gets back below 4.5.
Yeah, there was a good Bloomberg piece where they kind of talked about how you have a growing number of fund managers who are really saying that Treasury market repricing may not be over, may have more room to go, and that options are indicating maybe a spike in the 10-year back to 5, which is we've talked about a lot. That now becomes really a key psychological level, at least.
Absolutely, yeah. And I think the other thing to point out here, Josh, so markets close tomorrow. So we're going into this Friday jobs report, the December jobs report, with the 10-year at its highest level in about a year at this point. The key question being, if the report is hot, if it's better than expected, normally that would be driving up yields right now. How high could we go on Friday? Would that be good for stocks because the economy is doing well, or would it be bad for stocks because yields are rising, is sort of a question that strategists sit on both sides of the fence right now, but we're going to find out with Friday's market action.
We shall. Thank you, Joshua. All right, coming up, we are breaking down the volatility rates under President Trump and buying with today's chart of the day. Stick around, much more Ask for a Trend still to come. We are just days away now from President-elect Donald Trump's inauguration. Trump now considering declaring a national economic emergency to justify potential tariffs once he takes office. So what does Trump have in store for his first 100 days in office? For more, let's bring in now Sarah Bianchi, Chief Strategist for International Affairs and Public Policy at Evercore ISI. Sarah, it is great to see you. I thought it was interesting, Sarah. You are telling your clients that you're actually a bit skeptical here, Sarah, that Trump 2.0 policy mix may be, in the end, ultimately, as market friendly as perhaps a lot of equity investors are believing right now. Why do you say that, Sarah?
Well, last time in Trump 1.0, we really saw the thrust early on was around tax cuts and a big corporate rate cut that the market really welcomed. And some of the pieces that the market is less comfortable with, like trade and immigration, really didn't come till later on. And here we really see the reverse. We do believe Trump will start very, very early with trade and tariffs right out the gate, as you're reporting, as well as some aggressive immigration components. And the markets, at least the bond market, is very jittery about the level of deficits. And there's a lot of spending hurdles that this president has to deal with. So we just think that not all of that is priced in. There's a lot of great things going on in the market. So I don't mean to dismiss that, but we think this president's policies, it's going to be hard for him to take the actions that he's looking at without making the market a little bit nervous.
Let's talk about tariffs, Sarah, because of course that was again front and center in today's session, today's news. Do you ultimately believe, Sarah, that the tariffs are going to be as broad, as general, as sort of universal as he's talking about, or no, at the end of the day, after all the huffing and puffing and drama, they're actually going to probably be more narrow, more targeted?
Well, we've always thought that they're going to be targeted to specific sectors. That is how President Trump governed last time. He looked at specific areas, specific countries, steel, aluminum, certain critical minerals. That's the kind of approach we think he will take. So we don't think it will be a universal across the board, particularly given the concerns about inflation. That being said, we do get asked by investors a lot, is this just a negotiating tactic? That we do not believe to be the case. We think there will be tariffs, and it could be universal in every country. It could be those where the U.S. has a trade deficit. But if you're China, the EU, Mexico, Canada, Vietnam, you should definitely expect more tariffs from the United States.
So you should expect more tariffs there. But we've had some policy analysts like yourself on who say, listen, at the end of the day, yes, expect more tariffs, but they're going to be more moderate, more orthodox than the rhetoric suggests. And their reasoning, Sarah, to us was Trump wants to succeed for his own self-interest. He doesn't want to do anything that would in any way greatly upset the economy or the markets, especially for this president who we know looks at the stock market a lot as a kind of gauge, a 24/7 report card on what he's doing.
Look, I don't think he's going to do anything like he proposed in the campaign, a 60% across the board tariff on China and a 10% universal tariff or even higher around the world. That's not going to happen. But there are going to be, our estimate, last time the President Trump took tariffs from 3% on average to 10% on China, we think it could go to 20 this time. So that's not 60. But it's also not nothing. So there will be targeted, there will be clawbacks, exclusions for sure. But also we hear sometimes market participants say, he's really not going to do anything. This is really just a negotiating tactic. That we do not believe to be the case.
Sarah, great to see you. Great to have you on the show. Thanks for joining us.
Anytime. Thanks.
For our chart of the day now, we're looking at volatility during the first Trump term and Biden's presidential tenure. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Well, Josh, you've just been talking about some of the pronouncements, the promises, the commentary that comes out from President Trump. And those of us who covered, of course, the first Trump term had a little bit of deja vu about that period and the headlines coming fast and furious, in some cases, some knee-jerk reactions among individual stocks or sectors. So I decided decided to go back and look at volatility during the first Trump term, see how it compared with then the Biden term. And the period of time I looked at was specifically from election day to election day, because you started to have, of course, pronouncements, but also market reaction in that period of time. I looked at two different measures of volatility: the VIX, which of course measures volatility in the S&P 500, and the VIX EQ, which measures single stock volatility. So here's the period of time from election day to election day of the first Trump presidency. Of course, you saw a spike in volatility during the pandemic, but even including that period of time, volatility on average for the VIX was just under 18. For that VIX EQ was just under 29, lower than it was during the Biden presidency, where the VIX was just under 20 and the average for the VIX EQ was just around 34. Now, that said, the S&P 500 was up more in this period of time, election day to election day, under Biden than under Trump. But the takeaway is, despite all of this noise that we could potentially get out of a Trump White House, the markets were not terribly volatile. And this goes to the point that Michael Aroney of State Street made when we talked to him yesterday, Josh, and he talked about where investors should be paying attention. Here's what he said.
The earnings results are going to start coming through next week. They're going to be very good. And then ultimately, that's higher than both the 5-year and 10-year averages in terms of earnings growth. 6 or more than half of the economic sectors are going to grow their earnings by double digits. That should be the focus of this market, not Trump policy that's uncertain, not how many Fed rate cuts we're going to get. As long as the economy is growing and earnings are growing, this market can continue to move higher.
So Michael Aroney there with some advice for investors. Don't pay attention to the Trump commentary, especially when there's so much that's still uncertain. Maybe that changes when we get a little more certainty. He also said, as you know, don't pay so much attention to the back and forth on the Fed. If there is underpinning earnings growth, that is what is going to determine what we see in terms of stock returns. And as I say, that's sort of borne out here by that low volatility that we saw on a relative basis during the first Trump term. We'll keep watching this volatility chart, though, as we head towards Trump 2.0, Josh.
Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back Friday at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.